Federal Reserve balance sheet just hit $7.7 trillion, up from $870 billion in 2008. That's 785% expansion in 15 years. And nobody's talking about what comes next, because this isn't random. This isn't policy experimentation. This is stage 4 of a 5-stage collapse pattern that has repeated 3 times in the last century. Each time, the same 5 stages. Each time, wealth transferred from savers to debtors, from the middle class to asset holders, from you to them. Let me show you something. In each previous cycle, stage 4 lasted between 18 and 36 months. We entered stage 4 in March 2023. That was 21 months ago. Stage 5 is the crash, the reset, the wealth transfer event. And here's what you need to understand. Stage 5 doesn't announce itself. It arrives suddenly. Lehman Brothers collapsed in 48 hours. The 1929 crash took 4 days to wipe out 25% of market value. You're watching the setup happen right now. The same mechanisms, the same warning signs, the same institutional moves that preceded every major banking collapse in modern history. This is not speculation. This is pattern recognition. The banks know, the Fed knows, the Treasury knows, and they're positioning accordingly. Here's what they're not telling you. To understand why stage 4 is so dangerous, start with what bank collapses actually are. Most people think bank failures happen because banks run out of money. Here's the reality. Banks don't fail because they're broke. They fail because of duration mismatch and liquidity crisis. Let me show you how this works. Banks borrow short and lend long. You deposit money in a checking account. You can withdraw at any time. That's short-term borrowing by the bank. They take your deposit and buy a 10-year Treasury bond yielding 4.5%. That's long-term lending. The problem arrives when interest rates change. In 2021, banks loaded up on Treasury bonds yielding 1.5%. They paid depositors 0.1%. The spread was 1.4%, profitable and safe. Then the Fed raised rates 525 basis points in 18 months, the fastest hiking cycle since 1981. Now those bonds are worth 85 cents on the dollar. The bank holds $100 million in bonds. Market value drops to $85 million. That's a $15 million unrealized loss. Here's where it gets dangerous. If depositors withdraw their money, the bank must sell those bonds at market price. Unrealized losses become realized losses. The bank is insolvent. Silicon Valley Bank held $120 billion in assets. They had $91 billion in deposits. On paper, they were fine, but $15 billion of their assets were underwater bonds. When depositors withdrew $42 billion in one day, SVB had to sell bonds at massive losses. They failed in 48 hours. March 10th, 2023, 3 days later, Signature Bank collapsed. $110 billion in assets. Gone. First Republic followed. $233 billion in assets. The second largest bank failure in U.S. history. Total depositor withdrawals in March 2023, $472 billion. That's the fastest bank run in American history. The Fed's response? Launched the Bank Term Funding Program. $300 billion in emergency lending. Allow banks to borrow against underwater bonds at par value, not market value. Translation, they papered over the losses. They didn't fix the problem. They delayed stage 5. This has happened before. Let me show you. October 1929. The stock market peaked at 381 points on September 3rd. Banks had lent heavily against stock collateral. When stocks fell 25% in 4 days, those loans went underwater. Depositors panicked. Bank runs accelerated. Between 1930 and 1933, 9,000 banks failed. That's 40% of all American banks. The government response? Banking holiday. March 6, 1933. President Roosevelt closed every bank in America for 4 days. When banks reopened, only 75% were deemed solvent. Then came Executive Order 6102. April 5th, 1933. Confiscation of gold from American citizens. The government required everyone to sell gold to the Federal Reserve at $20.67 per ounce. 8 months later, the Gold Reserve Act. January 30th, 1934. The government revalued gold to $35 per ounce. That's 69% devaluation of the dollar overnight. Who won? The government erased 40% of its debt in real terms. Banks that survived became monopolies. Asset holders with real estate and stocks saw values recover. Who lost? Depositors lost everything in failed banks. No FDIC insurance existed yet. Gold holders were robbed of 69% purchasing power. Middle-class savers were destroyed. Fast forward to 1971. The Bretton Woods system collapsed. Gold backing for the dollar ended on August 15, 1971. Inflation exploded from 3% to 14% by 1980. Banks failed again. The savings and loan crisis between 1986 and 1995. 1,043 thrifts failed. Total cost, $160 billion then, 2008. Bear Stearns collapsed in March. Lehman Brothers in September. Washington Mutual became the largest bank failure in history. $307 billion in assets. The pattern is identical. Credit expansion, interest rate shock, asset devaluation. Bank runs, government intervention, wealth transfer. It's happening again right now. Here's what's happening right now. First, unrealized losses in the banking system hit $684 billion in Q2 2023. That's the highest level ever recorded. The FDIC reports that 63 banks are on the problem bank list, up from 44 in 2022. But here's what matters. Those are official numbers. The real exposure is hidden in derivatives and off-balance sheet obligations. Second, the Fed's reverse repo facility drained from $2.5 trillion in December 2022 to $200 billion by December 2024. That's $2.3 trillion in liquidity removed from the system. Money market funds pulled that cash. Banks lost funding. The liquidity buffer disappeared. Third, commercial real estate is imploding. Office vacancy rates hit 19.6% nationally. Buildings in San Francisco are selling for 70% below 2019 prices. Banks hold $2.9 trillion in commercial real estate loans. New York Community Bank announced a $2.4 billion loss in February 2024. Their CRE portfolio collapsed. The stock fell 60% in 2 days. Fourth, the Treasury market is flashing warnings. The 10-year yield spiked from 3.8% to 4.7% between July and October 2023. That is 90 basis points in 3 months. Bond portfolios got hammered. Regional banks hold $1.4 trillion in Treasury and mortgage-backed securities. Most are underwater by 10-20%. Fifth, insider actions reveal preparation. Jamie Dimon sold $150 million in JP Morgan stock in 2023, his first sale in 18 years as CEO. Bank CEOs sold shares at the highest rate since 2007. Warren Buffett's Berkshire Hathaway sold $36 billion in Bank of America stock in 2024. He's held that position for 12 years. Now he's out. Sixth, regulatory changes are accelerating. The Fed proposed stricter capital requirements in July 2023, Basel III. Endgame rules require banks to hold 20% more capital against losses. Why now? Because they know what's coming. This is pre-positioning. This is battening down the hatches before the storm. Seventh, the Federal Home Loan Bank system usage exploded. Banks borrowed $1.1 trillion from FHLBs in Q1 2023. That's emergency funding. That's desperation borrowing. This is not conspiracy. This is policy. This is data. This is the exact sequence that preceded 1929, 1971, and 2008. Here's exactly how this works. Let's say you're a regional bank with $50 billion in assets. You hold $30 billion in deposits. You've invested $25 billion in treasury bonds averaging 2% yield. You bought them in 2020 and 2021 when rates were low. Then the Fed raises rates to 5.5%. Your bonds are now worth $20 billion at market price. You have $5 billion in unrealized losses. Now depositors notice. They see news about bank failures. They worry. They start withdrawing money. Month 1, $2 billion leaves. You have $28 billion in deposits remaining. You can handle this from cash reserves. Month 2, $3 billion more leaves. Now you're at $25 billion in deposits. You need to sell some bonds to cover withdrawals. You sell $3 billion in bonds. But at market value, you only receive $2.4 billion. You realize $600 million in losses. Your capital drops from $5 billion to $4.4 billion. Month 3, depositors see the loss announcement. They panic. $10 billion exits in 1 week. Now you must sell $10 billion in bonds. You receive $8 billion. You realize $2 billion more in losses. Your capital falls to $2.4 billion. But here's the cascade. You now have $15 billion in deposits and only $2.4 billion in capital. That's a 16% capital ratio. Regulators require 8% minimum, but they prefer 10 to 12% for stability. You're approaching the danger zone. Depositors notice. Withdrawals accelerate. The death spiral begins. When X happens, Y follows. When bond losses materialize, capital falls. When capital falls, confidence drops. When confidence drops, deposits flee. When deposits flee, more bonds must be sold. The cycle feeds itself. By month 4, you're insolvent. The FDIC seizes control. Depositors get paid from the Deposit Insurance Fund. Your shareholders are wiped out. Your bonds get liquidated at fire sale prices. The bank disappears. Another casualty of stage 4. First, the largest banks. JP Morgan acquired First Republic for $10.6 billion. They picked up $92 billion in loans and $30 billion in deposits. Chase gained millions of wealthy customers overnight. Second, the Federal Reserve. They expand control during crises. The Bank Term Funding Program gives them leverage over regional banks. Crisis creates dependence. Third, private equity firms. They're buying failed banks and distressed commercial real estate at 60 cents on the dollar. Blackstone raised $30 billion for distressed debt funds in 2023. Fourth, asset holders with no debt. If you own real estate outright, gold, Bitcoin, stocks without margin, you survive the reset. Your assets may drop temporarily, but you can't be liquidated. Fifth, government through inflation. The national debt is $37 trillion. A 30% currency devaluation cuts the real debt to $26 trillion. That's $11 trillion in debt relief through theft. First, depositors above FDIC limits. The limit is $250,000 per account. Silicon Valley Bank had customers with $50 million in deposits. Those funds were at risk. Second, middle-class savers. Your money sits in checking accounts earning 0.5%. Inflation runs at 4 to 6% real rate. You lost 20% purchasing power since 2020. Third, retirees on fixed income. Social Security pays only $800 per month average. Rent increased 30% since 2019. Food costs up 25%. Healthcare up 20%. That fixed income buys less every year. Fourth, employees without assets. Your wages might increase 3% annually. Asset prices increase 8 to 12%. The gap widens. You fall further behind every year. Fifth, small and regional banks. They can't compete with giants. They can't access Fed support like major banks. They get acquired or fail. Over 4,000 banks existed in 2000. Only 4,100 remain today, and that number is dropping. Sixth, borrowers with adjustable rate debt. Your mortgage resets from 3% to 7%. Your payment doubles. Foreclosures increased 23% year over year in 2024. You lost 18% of your purchasing power between 2020 and 2024. The average American worker earned $54,000 in 2020. Adjusted for real inflation, you'd need $70,000 today to maintain the same standard of living. Most Americans got a 15-20% raise in that period. They're still behind by $4,000, $6,000 annually. That's the theft. Silent? Legal? Devastating. Here's what you need to do now. First, diversified bank exposure. Never exceed FDIC limits in a single institution. If you have $500,000, split it across 3 banks. Open accounts at multiple institutions. This protects against individual bank failure. Second, allocate 10-20% into hard assets. That means physical gold, silver, or Bitcoin, not ETFs, not paper claims. Physical possession. Store gold in a private vault, not a bank safety deposit box. The government can seize safety deposit boxes. They did it in 1933. Target 15% of liquid net worth. If you have $100,000 in savings, move $15,000 into gold or Bitcoin. Third, reduce exposure to long duration bonds. If you hold treasury bonds or bond funds with 10+ year duration, consider selling. Move into short-term treasury bills or money market funds. Keep duration under 2 years. Fourth, eliminate adjustable rate debt. If you have an ARM mortgage or HELOC, refinance to fixed rate. Lock in rates now before they spike higher. A 30-year fixed at 7% is better than an ARM that could hit 9-11% in stage 5. Fifth, increase cash reserves to 6 or 12 months of expenses. Keep this in short-term treasury bills, not checking accounts. T-bills yield 5% with zero risk. Checking accounts yield 0.5%. If your monthly expenses are $5,000, maintain $30,000, $60,000 in T-bills. This provides stability during volatility. Sixth, avoid commercial real estate exposure. Don't invest in office buildings, retail space, or commercial REITs. The CRE crisis hasn't bottomed yet. Values could drop another 30-40%. Seventh, study the pattern. Read about 1929, 1933, 1971, and 2008. Understand what worked and what failed. Gold holders in 1933 got confiscated but still came out ahead long term. Stockholders who survived 1929 recovered by 1945. Knowledge is protection. Pattern recognition is survival. The 5-stage banking collapse pattern is not theory. It's documented history. We're 21 months into stage 4. Stage 5 is the crash, the reset, the transfer. You have a choice. Position yourself now or lose wealth later. The banks are preparing. The Fed is preparing. The insiders are selling. The middle class always loses in these transfers. Unless you understand the pattern and take action. Join the Economy Rewind membership for weekly updates on crisis indicators, positioning strategies, and early warnings when stage 5 approaches. Link below. Share this video with everyone you know. Most people have no idea this pattern exists. They'll thank you when stage 5 hits and they're protected. The window is closing. Stage 4 doesn't last forever. Position yourself now. Not financial advice. Do your own research. Verify every number I've shared. Study the history. Make your own decisions. But make them soon. The pattern doesn't lie. It only repeats.